The United States economy is at risk of stagflation, which is defined as a period characterized by sluggish growth and persistently high inflation. This would cause investors to favor stocks over bonds, according to JP Morgan, which is a financial institution. The company believes that we might be on the verge of experiencing a stagflationary environment similar to the one that existed in the 1970s. Equities were flat from 1967 to 1980, and with yields averaging above 7%, bonds significantly outperformed stocks, JP Morgan said in a note on Wednesday. The note also highlighted the fact that a yield increase from options such as private credit could be a game changer in terms of the potential boost in long-term portfolio performance. Concerns about stagflation have increased as a result of a recent string of economic indicators that have been hotter than anticipated. This is in contrast to the numerous optimistic Goldilocks projections that were made in the past, which projected that inflation would lower and that GDP would be robust. And further reason that JP Morgan noted for the possibility of stagflation was the presence of geopolitical tensions. The company pointed out that conflicts in Vietnam and the Middle East during the 1970s caused oil crises, disruptions in shipping, and an increase in deficit spending. According to the company, this is a reflection of the current volatility in the Red Sea, which is caused by the conflict between Israel and Hamas, Russia's invasions of Ukraine, and tensions between the United States and China. It is conceivable that a combination of high interest rates and an unpredictable geopolitical environment will result in a reduction in liquidity, according to JP Morgan. If one adds volatility that can come from political, geopolitical, and regulatory uncertainty, public markets are further disadvantaged versus private markets that can avoid the limelight of daily volatility, according to the financial statement. Jamie Dimon, the CEO of JP Morgan Chase, has stated in the past that the year 2024 may be comparable to the 1970s. He has stated that the big fiscal deficits, alterations in trade patterns, and commitment to substantial government expenditures are all inflationary. Robert Kahn, managing director for global macroeconomics at the Eurasia Group, told Nikkei that stagflation is a possibility in 2024. This is despite the fact that projections of a recession in the United States this year proved to be erroneous due to strong consumer spending. Kahn, who had previously worked as a senior economist at the Federal Reserve, is of the opinion that the Fed is quite optimistic in its anticipation of a gentle landing for the economy. He issued a warning about a potential negative situation that would be caused by a significant decrease in demand brought about by high oil prices and unfavorable developments in other countries, notably China. We have included some edited portions from the interview. In spite of rising inflation and quick interest rate hikes, why has the economy of the United States been so robust? Since the beginning of the epidemic, the United States government has implemented a fiscal policy that has been more expansionary than that of practically every other country. This has resulted in a considerable amount of support for demand, which we are still working through. Prior to the Federal Reserve's decision to tighten monetary policy was also very easy for a considerable amount of time. A lag is a characteristic of monetary policy, as you are aware. In conclusion, I would conclude that up until quite recently, the policy has been quite supportive of demand. However, a significant number of these elements are beginning to reach their conclusion. A number of economists anticipated that this year would be a recession. Do you believe that they made an incorrect assessment of the strength of consumer spending? Answer: that is a really significant and challenging question. As we observe, consumers in the United States continue to burn down their savings in order to boost consumption. However, a portion of that was a savings that was accumulated in the early years of the epidemic, which served as a reflection of the growth of fiscal policy during that time period. A portion of it was due to productivity that was higher than anticipated, as well as a highly robust job market, which led to an increase in earnings and an increase in household income. Policy also played a role in the outcome. Additionally, the president's decision to discontinue making payments on student loans contributed to an increase in spending. The Federal Reserve anticipates that the economy of the United States will have a gentle landing. In what way do you feel? Answer: if the Federal Reserve were to be successful in bringing inflation back down from high levels without causing a recession, this would be a very significant achievement. But that is a very hopeful outlook. It is ultimately predicated on the assumption that the majority of Americans do not experience any financial strain as a consequence of these higher rates. We are currently experiencing an unusual expansion, during which the labor market was quite competitive and there were a great deal of open positions. As a result, I believe that what we are witnessing is a decrease in the number of available positions, which is a greater trend than the rise in the unemployment rate. In addition, what we are witnessing right now is that individuals are returning to the workforce at the same time that the number of available jobs is increasing. This indicates that the rate of unemployment does not need to increase as much. Taking all of this into consideration, it seems to us that the labor market has been adjusting to these higher rates in a very smooth manner up to this point. However, it is important to note that changes to high rates frequently involve a smooth transition followed by a sharp one. There are times when we can observe quick adjustment, particularly in the later stages of the adjustment process. Is there a possibility that stagflation may occur in 2024, which would be characterized by high inflation and low economic growth? Answer: I believe that there is. I believe that we have witnessed over the course of the past few years that the pandemic has caused shocks that have had long-lasting consequences on supply chains and as a result on prices, as well as the fact that the process of readjusting to situations that are more typical has been challenging and time-consuming. At the same time that workers in the United States are looking for improved wage growth, we are witnessing strikes in many other parts of the economy. The supply chain continues to experience minor interruptions at this time. It appears from all of this that the progress that has been made to reduce inflation may also be inconsistent. According to my opinion, a dramatic decline in demand, a loss of trust, the pressure brought on by high oil prices, and unfavorable developments in other countries, notably China, are all factors that would cause a more severe decline. Concerns about inflation have led to a lack of response from the monetary policy establishment. Therefore, the worst-case scenario is a significant decrease in activity, continued high inflation, and this is what is known as the stag. This is a form of stagnation, often known as stagflation. As for the dangers posed by the stress of the financial market, my opinion is that we are not yet out of the woods. I am of the opinion that there are still some small and medium-sized banks in the United States that are going to probably run into problems, and they will either need to merge or be interfered in order to avoid further problems. However, at this time, I do not consider it to be a systemic risk to either the economy of the United States or the economy of the entire world, and I am optimistic that we will be able to deal with it. The epidemic has caused a significant shift in the way people work, which has resulted in a severe glut of commercial real estate in the United States, including offices. Answer: there is a huge problem with commercial real estate transactions. There is a surplus of commercial real estate available for purchase. It is especially in specific cities where we have witnessed workers leaving, which has resulted in a decrease in demand. It takes some time for that crisis to become apparent because it often becomes apparent when leases reach their expiration date and when attempts to perhaps roll over funding are unsuccessful. I believe that this issue will become apparent over the course of the next 2 to 3 years. In particular, as I mentioned earlier, there are some cities in which we are currently experiencing very high vacancy ratios, and as those leases come to an end, I believe that the owners will have difficulty obtaining financing. The Federal Reserve has stated that it will maintain very high interest rates until it is certain that it is successfully bringing inflation back down to the goal level of 2%. Since this is the case, rates will remain roughly the same during the most of the following year. It could possibly be a little bit higher, and the commercial real estate industry will suffer as a result of this limitation. In the end, the consumer in the United States is the most important factor in determining the possibilities for growth. We are seeing more evidence that more households are beginning to feel limited as a result of rising oil prices, higher student loan payments, higher credit card bills, and other such factors. As a result, I anticipate that growth will slow down quite a bit in the subsequent quarters. Share your opinions in the comments and subscribe now for more. Thanks for watching.